Hello guys and welcome to another developed video. Today taking an in-depth look at PVH Corp, formerly known as the Philip Van Heusen Corporation. This is an American clothing company which owns brands such as Tommy Hilfiger and Calvin Klein. The company also licenses brands such as Kenneth Cole New York and Michael Kors. So PVH Corp, as we see, is priced at approximately $65. They have a great free cash flow yield of 9.8%. Their price to earnings is 5.3, so they're pretty undervalued compared to the market right now. But let's check the business metrics. The return on tangible assets is 11.5%. The return on equity is 12.96%. The return on invested capital is 8%. The current ratio is 1.2, which suggests good short-term liquidity. So this is pretty good from my point of view. Now let's check Grant's valuation, putting in their estimated earnings per share for the next year and a factoring in a minus 1% growth rates because from what I've looked at their future estimated earnings per share, they will slightly decrease. So I just put in a minus 1% growth rate, and we get a buy price which is slightly higher than today's current price. Now, for the dividend discount model, I think a minus 1% growth rate is also one minus 1.5% growth rate is also warranted because if the revenue drops by minus 1%, their free cash flow will drop by more than minus 1% because as you sell less, your margins start to contract, and this is sort of a cascading effect where your free cash flow drops faster than revenue. And for the perpetual growth rate, I think somewhere in between 0.5. So let's put in 0.75% because it is well below. I usually put in 2%, but I think they'll slightly recover from the current routes they're in, from the current problems they're in, but I don't think they'll go on a great path. So that I just put in a 0.75%. I always put 2%, but in this case, they are a declining business. Now, we get a DCF price per share of $93. Next, let's go to the historical multiples. We can see that the average PE of the last 10 years was 18.97, which is really interesting because the current price to earnings is 5.3. Now, I couldn't compare to other companies because you shouldn't compare a declining business. Technically speaking, it's just clothing. It's just um, a normal clothing company. Could have compared it to Nike or Adidas or Puma, but there is no reason to do that since they do not have a great business. Nike has a business that even in its bad period is still growing very slowly. Um, but PVH Corp is not the same, so I cannot compare their multiples. They're not the same. And the dividend discount models is not warranted here because their dividend is small and they do not seek to increase it. And as for the output, the average of these two, the grants and discounted cash flow valuation model, we get an acceptable buy price, applying of course, a 15% margin of safety. We get an acceptable buy price of $68.65. And if we apply 20% margin of safety, we get a buy price which is extremely close to the current price. So they're trading at about a 20% margin of safety, which is, in my opinion, a really good thing. Now, as for the problems with PVH Corp, in my opinion, a lot of brands, clothing companies, they may be a good investment on paper. For example, um, there are some businesses which, of course, Warren Buffett doesn't like retail businesses, but there are also clothing companies which also he does not like. It's not the same as retail, but as we can see here, they have great business metrics. They're not that bad. 8% ROIC is pretty good. 13% ROE is pretty good. 11.5% return on tangible assets is pretty good. 1.12, 1.20 current ratio is pretty good. But problem with these types of businesses is that they rely too much on brands. So anytime this brand starts to decrease in popularity, you are basically in for a very bad period because these periods last a lot. I mean, Crocs had a few years of non-stop hate from a lot of people, but now of course they've rebounded, and they've had a lot of success with their stocks, with their net income, of course. Um, I made a lot of money from Crocs, but uh, I'm getting besides the point. The point is that this is an interesting business from a business perspective, but the problem with this business perspective is that it does not take into account the risks that come with this, because there's a lot of risks. The brand may die, the management may cheapify the brand, so to say, so they make it too cheap and the brand dies. There are a lot of risks here, and this is what I don't like here at in apparel companies, in clothing companies. Now, if you really want to take a risk on this, I suggest you seek a 25 to 30% margin of safety. A 20% margin of safety is okay, but I usually invest with 30 something percent margin of safety. It is the best, in my opinion. I've really never failed with anything more than a 30% margin of safety. When I do a 40% margin of safety, I know I'm getting my money back. It is such a great thing to use margin of safety. I suggest you do too. Now, of course, you do all investments based on your own due diligence. Please check out your other tools to analyze companies. For example, we have ticker data. It's a link in the description below. You can use ticker data template to analyze a stock. There are many different ways to analyze. You can even analyze banks. You can actually analyze your own portfolio. You can analyze individual companies for complicated DCFs. So there are a lot of tools there. I suggest you use in ticker data. You can, as I said, you can check it out in the link in the description below. Also, do not forget to check out my investing blog, where I've recently posted an article about the AI bubble and Trump's tariffs, so commenting on both the stock market and the economy. And yeah, this has been it for today. I have to see you in the next video. Bye.